Well, hello and welcome to Jazz After Dark, everybody. How you doing? This is a show, by the way, for those that don't need to rush through some of the stuff that you see on the shorter form social medias out there. This is for those of you that want to hang out and learn a little bit while you share a drink, man. Long day, you just want to watch something. By the way, Long Branch, Kentucky bourbon. This was I'm not kidding. My neighbors do this, but neighbor guy, he's over there actually. Different neighbor came by. He's like, "Watch the show, man. That's cool." So he gave that to me. Is that what he gave to me? Everybody gives me stuff. It's so cool. Anyways, it's very good. It ranks to the top of my list actually. I think it's very good. It's very spicy, but it's not too like overpowering. It's not along the lines of like a Buffalo Trace. Yeah, and I like I like a spicy. I like it. Yeah. Um, since we're just talking here, right? We are all literally bat you know what crazy when it comes to money. I get it. It's a super emotional thing. Imagine how I feel, and this is not marketing. I'm just going to throw this out there. We manage about $300 million here at Jazz Wealth. Thankful for every last penny and every last client that's given us an opportunity, of course. You imagine how we feel when we see the balance go up and down? Like, you know what I mean? It takes some time and some getting used to. And our company, by the way, we only make more money if your account goes up, right? So we don't sell you stuff and we don't make money by like a subscription or something. So we need that account balance to go up in your way, right? For your goals. So I can safely tell you, I'm pretty much dead inside when it comes to investing and finances. I'm so data driven and stuff. It doesn't bother me. But I get it that a lot of you will take some time to get to that point, and maybe you're a bit emotional. You're either mad because you're out of the market, you're mad because you're in the market, it's going down, you worry about when to put the next big chunk of money in. You get it. I mean, you can tell me in the comments what you're living through, and I won't make fun of you because it is a very emotional thing. We make these massive decisions with a long timeline and we don't know, right? We're just assuming we'll get it right and the markets will continue, and it always has and it always will, but still very, very challenging to do. It's kind of like taxes. You get a little frustrated. You're like, I'm paying in, but I'm not seeing money getting put to use. I'm not seeing the growth of money. I give money to the government, it seems to disappear. It's gone. They spend more of the money than I give to them, right? So it can be emotional, and we don't have to start that discussion tonight. But I want to share a few things with you tonight to help ease some of your calm or your worry, or at the very least make you go, huh, okay, yeah, I didn't know that's how that would go. And I'm going to dive around just a little bit here with some of the things. We'll make this very visual tonight. First up, did you know that there is about a 1 in 5 chance that the market will lose more than 10% in a given year? This is actually from an old wine and wealth class that I did for clients. Here's how that breaks down. We are taught that the stock market will gain an average of 7%, right? Now, let me interrupt real quick. So 7% is the number that you see. If someone ever tells you 10%, that's not wrong. They just maybe missed a word or two. So we say 7% as an after inflation number. Very much an honest number. That's a realistic number. If someone says 10%, they may be trying to sugarcoat it a little bit, but what they're telling you is the raw return is 10%. It actually is almost 10% over the life of the market if you don't account for inflation, right? But most of us say, okay, 10%, but there's inflation. Let's back out a few percent. We end at the 7%. You get where we're coming from? So nobody's wrong when they say that. I've seen people pick on other people, and it's like, well, they maybe should have said an inflation adjusted or not inflation adjusted number, raw return, but nonetheless, it's what it is. Okay, so we're taught whether it's 7 or 10%, here's the distribution of the market's returns, and only 6.7% of all the time, like the entire history of the S&P, have we actually returned between 5 and 10%. Meaning we returned either the 7, the 8, the 9, the 10, or the 6 or the 5. It almost never happens. It's the second least likely scenario to happen, other than, maybe the market's falling a little bit. So think about that for a second. We're told to expect a return, but we almost never see it. We'll see more, we'll see less, we'll see an average, but we almost never see that average. So when you look at your account in a given year, 2018 was a horrible one for people because it was just zero, right? It was just the markets gained nothing. But when you look at your account and you go, this year you wouldn't say that, but other years you might go, I'm not tracking along the average. That's okay, right? It's totally normal. So if we look forward, we also hardly ever see just a slight down year in the market, and that makes perfect sense. Emotion in this way, so the markets, let's say, are at zero, and they start falling. We get emotional. We start selling more and more and more, and so here we go. There's a 21.3% chance that we lose more than 10%. So that's just emotion. The same thing is true with greed, but we'll get there in a second. Here is from 2008 to 2018. Just look for any spot where we lost something that would fit in here once, right? That's that year I was telling you about. It was basically flat. We just chopped around. At the end of the year, it gave us a little kick to the downside, and that was it. Right there. Other than that, here's just I guess I handpicked it, but a 10-year window where we've tried to find something that fit into there. Now, you have over a 50% chance that you will gain more than 10%. That's pretty awesome. I'll take that. That's why the average holds true at either 7 or 10%. So that's just greed. When the markets are doing well, we want to buy more. We want to chase more. We want AI. Oh my God, it's the next greatest thing. I have to buy more. Who cares what it costs and that I'm paying 40 times more than it's actually worth? Greed, it gets the best of us. That's an emotional thing that happens. I can't solve for that. But if we take the same 10-year period, look at all the points where we landed greater than 10%. Okay? So it makes perfect sense there, right? Now let's take a look at some other stuff. Those of you that fear being out of the market, or you say, I will get 100% out of the market and wait for better days. This is tricky. Everybody shows this chart. This one's kind of fun, but we're going to go somewhere with this today. Average return, inflation adjusted, 7.63%. If you miss the best 10 days over the last 25 years, your return would only be 4.3. That's just 10 days. You just missed the 10 best days. If you missed the best 20 days, 2.1, missed the best 30 days, you might as well not have even invested. And if you plan on being out of the market and you happen to miss the 40 best days, the 50 best days, you would have been better off doing anything else with your money. Another way to look at this is inverse to the way that, how I say it, most people say they want to sugarcoat the good stuff. What's the likelihood that I make 10%, or I'm on a day trade, and what's the likelihood this happens? Well, it can all be boiled down to a stat. However, let's go the other way. What's the likelihood that the market would actually fall over various time frames? So over a 1-month period, you have a 37% chance of the market falling. Okay? This is just the S&P's data. This is not my belief, thoughts, or opinions. This is the data. If you were out for 3 months, you've got a 1 in 3 chance that the market will be lower. So in other words, if you felt strongly that something terrible was going to happen, you better hope it happens within a 1 to 3 month period. Because the longer you go, if you go 6 months, there's basically a 30% chance. And in fact, if you go 20 to 30 years without being in the market, there is never been a time where you would have been better off, you would have been in good shape doing that. Never has the market been lower over a 20 or 30 year period. Meaning if you were horrible, you were just the worst investor ever, and you bought at the top of whatever the market was, and you waited 20 years, you'd make a profit. Wouldn't be great, probably, but you'd still make a profit, okay? So we don't want to miss out on those best days. Another way to explain this is if we know what the volatility is expected to be, then we can decide ahead of time if we're willing to accept that. So if I told you that the house down the road was up for sale for $500,000 and it's beautiful, has everything you could ever want in it. The trouble is, for whatever reason, let's say it was in a flood zone, out of a flood zone, in a flood zone, out of flood zone, and they just kept redrawing the map. And so some years that property was worth $250,000, some years it was worth $750,000. Generally, there's still an uptrending direction, but the change in returns year by year was volatile. That's what we mean when we say volatility. Well, you can do that with anything. Sadly, most people don't do that with real estate. They just say, well, I can't see the balance every day, so I'll just buy it and hold on and get rich, right? That's what a lot of people think. If we look at the S&P, and this is only the S&P, I have a lot of fun doing this with 60-40 portfolios, all bond portfolios, alternative investments. I like to see what that volatility is because if I don't tell you that ahead of time, the phone's going to ring. You know what I mean? If you say I want something safe and then I put you in the S&P, first of all, I would never do that. But if you said that, I have to expect you're going to call and go, Dustin, what the hell? It's going all kinds of crazy there. So do this with whatever you're going to invest in. Here's the S&P. All right. So basically what we did is we said each year, what was the max drawdown, meaning from a high to a low, what was the furthest we had to see it go down? You might know during the COVID years, that's probably the closest in history you can remember. But in 2020, we fell 33.9% on a closing basis during COVID. It was just a waterfall drop to the downside, right? So that's pretty scary. I don't know that if I was all invested at that point, can you handle that? That's a bit tough. Another tough year was during a financial crisis. That's about 50%. We might as well just say that's 50%. It's kind of nasty. 2 outliers, pretty nasty outliers. Shift over here, and you really only have 2 over here as well during the .com the bust, the tech stocks going nuts. Pets.com, trading for billions of dollars, all that stuff. But you can see that these are sort of grouped together. So it takes a bit of chaos to get the markets to fall so significantly. The market just doesn't fall 40% for no reason. It has to be like a worldwide shutdown, or the financial system is, oh my God, maybe there's a problem, right? What happened this go around? SVB Bank and all the others, it was like, oh man, is there a problem? Well, it didn't really matter because the problem was sort of focused on those small banks, and it was Fed driven, to be honest, but that's a whole separate video. But we know that on average, we would see about a 14% drawdown. It's at the bottom here. So mixing in some chaos here and there, and then just some normal years where the market pulls back. I don't know, maybe it just ran up too fast and took a little bit of a break. All right, the average is about 14%. The average range from high to low is 26%. Okay? What does that mean? So we pick on that chart, we pick a point and we say, what's the highest point? Show us the lowest point. And then what was the difference there? So was that 15%? Was it 20%, 48%? What was it? And then we just plotted that for each year. However, that's from the highest point to the lowest point. The range is from top to bottom to top to bottom. What's that back and forth range? Meaning you might go up 10%, fall 33%, right? That range is plus 10 minus 33. So we've got a 43% range. That's true volatility. And so I wanted to plot that as well. And so that's where you have 26.8%, meaning your investments in any given moment could swing around by that much. And you wouldn't necessarily be down 26%. You could have been up 15% and then fallen 15 plus an additional 14% to get you to 14 down. You see what I'm saying? So don't let that confuse you there. Do I have one more for you? That's for a different class. So anyways, think about that. If you can accept the volatility and the expected returns of whatever you're investing in, tonight we use the S&P as an example, but if you can accept that, then it's worth investing in. Now your emotion just stopped because you accepted it from the beginning. If you look at something like maybe gold, everybody asks about gold, and what's the range on that? You may say, it's the inflation protection and it's safe play and all that. Nonsense. I disagree with that 100%. However, if you were going to invest in it, can you handle the range in gold? You're already emotional by making that switch to gold. Can you handle the back and forth? What's the expected range? What's the max drawdowns on given years? Those are the questions you should be asking before you just dump your money into stuff. And I'll leave you with my favorite saying of all times. There's a guy down here in Sarasota, and he's gotten a little crazy in his old age, but as a kid, I used to drive around and listen to any stock market stuff I could. And I'm talking when I was like 16, delivering menus to restaurants and stuff. That was my sort of job. The guy went on this, his name was Phil Grandy, and I think he's still out there actually. He went on this tear about we'll go into the grocery store and we will molest a cantaloupe for $4. And we want the best one. We're going to squeeze it and smell it, and toss it in the air and go, all right, out of all of them, this one's okay. I'll take this one. It's $4. But yet when it comes to the stock market, we'll go, I love it. Get me in. Tens of thousands of dollars, and you just click a button and you're in. Have some thought. Think through what you're expecting. Think of it as a business. You are investing. You expect a return. You expect some volatility, good times and bad. But what can you handle? If you can handle that from the beginning, there's really no emotion that should get in the way other than maybe some excitement. All right. I'm going to wrap it up there. I appreciate you guys hanging out with me tonight. That's all I have for you. We'll see you tomorrow or something. I don't know. I need a sign off, right? Like a good day, America. I don't know.